and welcome to the show. My name is Doug Hepburn. I'm your host of Hepburn Financial Advisors, a boutique wealth management firm located in Phoenixville, Pennsylvania, helping businesses, executives, and independent women successfully navigate financial changes for over 20 years. I'd like to welcome my co-host, Robin Bond of Transition Strategies, a team of tenacious lawyers effectively advocating for their clients at every stage of the employment relationship. Hello, Robin. It's the mid-year.
Hey, Doug. Yeah, we're almost halfway through the year. Can you believe it?
I know. It's time for reviews, right? Isn't that what most employers are doing these days?
Well, yeah, this is the mid-year review cycle. So if you have people working for you, this is a time for you to be reviewing salaries and identifying any potential issues. Of course, all the advice I give today, you can flip it if you're the employee and take the advice, the same advice. But, there's a few things. If you have people working for you, maybe three main tips I'd like to point out at this time. You want to be looking at salaries relative to pay ranges. Some of the top performers are often found at the very top of the pay ranges. And then companies are in a situation of, well, I can't increase the pay anymore. Then you get into the problem of potentially losing those employees, especially if they're motivated by earning money. So then you as the boss have to start thinking of, well, what else can I offer them if I can't offer them money? Maybe new leadership opportunities or mentoring or development opportunities. These are all things you need to be thinking of. And same thing if you're the employee. Maybe you can be asking for something like a performance bonus that's outside the pay range in addition to these leadership opportunities. Secondly, pay equity is still the law. So if you have longer tenured people working for you that aren't earning as much as your new hires, yet they're performing the same or essentially the same job duties, you need to be looking at that. And so then the third point would be verifying that if you find those kind of discrepancies, you can justify those discrepancies based on, number one, performance, or number two, skills and abilities, because people doing the same or similar jobs need to be paid equitably for those jobs. So just a few thoughts as we hit the mid-year review cycle.
No, that's great advice. I can think of a couple of people who are in that situation where they've topped out the pay scale and are thinking, do I stay where I'm at or do I go somewhere else? Because oftentimes, your greatest growth in salary ends up coming through job change.
Absolutely.
Most employers are reluctant to give somebody too big an increase. But, if you've got top performers, you got to do something to hang on to them. Otherwise, you end up with the bottom performers, taking over your company. And that's not necessarily the most efficient thing for contracts or businesses as you might have. So the rule of thumb there is take care of your employees, because human capital is probably the most valuable asset a company has that doesn't show up on the balance sheet. In economic news, we've had a number of things come out. Mortgage rates continue to weigh on pending home sales. It's interesting. Robin, you and I both remember when mortgage rates were even higher than where they are now, probably double digits. And I know
really, I thought it was a great deal. I got like 8.5%. I was like, wow, that's
great. Exactly. And now people are screaming like bloody murder as if they're getting their throats slit by, a 6.5%, 7% mortgage.
Yeah.
But, it's definitely made homes less affordable for many people, in particular in the first-time home buyer market. That is, usually the most affordable area of the market besides Section 8 housing, but it's starter homes are where it's the first stopping off point for people who are leaving apartments and going into household formation. So I think the mortgage rates are really more of a psychological barrier, but it's also a financial barrier because your mortgage payment's higher. As a result, the new homes for first-time home buyers are actually getting smaller because the home builders are seeing their prices for input costs go up. So now, in order to make the same profit on a home, they've got to shrink the size of it and take out some of the amenities. So that's an interesting development that we're seeing. In the meantime, the Federal Reserve Chairman Jerome Powell has signaled that there's not going to be any changes in interest rates for the near future, as any decision is going to be based on, quote, careful, objective, and non-political analysis. This statement came out after a meeting with the president, who's been vocal about the need to cut rates to remain competitive in the global marketplace. So it's some, I hate to say it, more of the same, kind of status quo. People are still wanting to buy houses, but locked into apartments because whether it's a true financial issue or a psychological issue with interest rates, have been reluctant to buy first-time homes. And there's not a whole lot of inventory coming on the market. And we've talked about this in the past, because most people refinanced, hopefully, in 19, 20, 21, where interest rates were at their lows, and anybody who's got a 1.5%, 2.5%, 3%, even a 3% mortgage rate is unlikely to go and sell their house and buy a new one at a much higher rate.
Right. So
that's sort of put a stall on any new existing homes coming on the market. So new construction is really the only place where people have to go. In other economic news, we've seen a lot of job cuts announced by the administration, many of them resulting in litigation to halt the terminations of government employees. And which brings up our viewer question from Jack Martin of Philadelphia, which is, what is the best practice for documenting employee performance issues and terminations?
I'd be happy to answer that for you, Jack. The best practice, there's a couple things that I would recommend if you're going to do that. Is number one, focus on facts. You don't want to say, oh, you have a bad attitude. That's too general of a statement. What you want to say is, what are the specific actions or behaviors that are causing problems, and what problems are they causing that need to be fixed? A lot of especially millennial generation, always wants the answer to the question, why is this important? But focus on facts, because if you focus on facts and specific actions and behaviors, that creates a sense of fundamental fairness to the process. A lot of times documenting so-called performance behaviors are not fundamentally fair. They're fundamentally designed to drive people out of the company. Second thing is, maybe give examples. When you do X, it causes this problem. When you do X, it causes Y. So be specific, and then set some clear expectations. Here's what your job description says. This is what I expect you to do. Here's what the employee handbook says. I expect you to follow that. Here's our code of conduct. Here's what you need to do. Be very specific and clear with your expectations. And finally, have consistent follow-up. You have to meet weekly with people that, where you're documenting performance, and give continual feedback. What's good and what still needs to be done. And hopefully that will be, a helpful and constructive way to deal with the problem.
That's great advice, Robin. I think in a lot of employer-employee relationships, there oftentimes is that gray area between, what people are expected to do and what the expectations of that employee are. And the reality is, if you do what you're told and you do it as best you can, you're probably going to succeed, unless the employer has not really laid out that path to success. So excellent. Thanks, Jack, for sending that question in. If there's something you'd like to ask, here's how to send your questions to Money Matters TV.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
For investors who want to make a large purchase, access to capital on short notice can make or break a deal. For many banks, the underwriting process is not fast enough to accommodate borrowers who need money quickly. Additionally, some borrowers may not be creditworthy enough to secure bank lending. As a result, after the financial crisis of 2008, the markets responded with what are known as hard money lenders or brokers who assist those investors in those situations. To explore this subject, our guest today is John Heimen, and he's here to discuss it, and hard money brokers and how they facilitate transactions that need to be done quickly and may not have the best credit quality. Welcome to the show, John.
Thank you, Doug. Glad to be here.
Why did you get started as a hard money broker?
Well, Doug, that's a good question. And I wanted to be able to make a change in the community because of the fact that I realized that people who needed money for the housing industry, they actually make a change in the community. If you look at it, when they buy, fix, and flip a house, they give somebody that ability to move into a better house, and they improve the community. And it also provided me with an option as to how to help fund these cash buyers and real estate investors that have a difficult time obtaining a loan with a bank.
Well, John, if somebody was interested in setting up a hard money brokerage, what type of entity do you suggest if someone wants to get into this line of work and be a hard money broker?
I would suggest that they go ahead and form an LLC, they can form a corporation or incorporation. Do not be a sole proprietor. This way that any legal documents or activity that may come against you come against the money, the company, and not you as the person.
Yeah, that's good advice for liability shielding. And certainly I'm sure you recommend they buy several layers of professional liability insurance as well.
Mm-hmm. Yes. Yes, I do. And that's a great advice because some of the insurance policies you can find it directly online and they're not that expensive. I know that one person I know of, their insurance rate is $39 a month for $100,000 insurance policy.
Wow. Well, that's the barriers to entry seem pretty low. I mean, what type of training do people have? I mean, what sort of background do you have that allowed you to get into this business?
That's a good question, Doug. And in the year 2009, I actually worked for Bank of America. They bought Countrywide Mortgage, and Countrywide Mortgage, they wrote mortgage loans with people who financially couldn't afford it.
Right.
I remember.
Right. They were at the epicenter of the financial crisis.
Yeah, I remember that. Boy, I haven't heard that in a lot of years, but now it's all coming back.
Yeah. And when I worked for Bank of America, and I was a short sales broker with them, I would average 30 properties to close a month.
Wow.
And it was a contractual position for a year. So I dealt with lenders, buyers, real estate agents. And if we had an offer of a property for 75% LTV, loan to value, they would accept it. So, for someone that actually wants to get involved in the industry, I would recommend short sales. or foreclosed properties. And if they were willing to put some sweat equity into it, it'd be worth it.
Gosh, that that just brings up a whole lot of questions as you're talking about it. I've always been afraid to do these foreclosure things because I think, well, what kind of liability would I assume if I bought something at a short sale or a foreclosure? Can you answer that? Like, what kind of liability would I potentially be risking if I bought something at a foreclosure?
No, the only thing that you would be risking is usually in a foreclosure, the property is sold as an as-is property. So if you need to fix the air conditioning, the foundation, the roofing, which are the three major expensive parts, that would be your liability.
Yeah, but can you see that? Can you go and look at it and know what that liability is? Do you know if there are tax liens? Do you know any of these things?
Well, the state does have tax liens that you can get a record of the tax lien of the property by the APN number.
Mm-hmm.
And you can research that. And that would all be handled by your title company as well and your attorney when you go to closing.
Thank you. That's super helpful.
Just to sort of continue down this line of discussion, I happen to know somebody who bought a property in foreclosure, and has been trying to take possession of it, and unfortunately, the county sheriff, this is in Philadelphia County of all places, the county sheriff has been, let's just say, slow to serve the person who's living in the home. So here, this individual has title to the property. They've incurred liability to buy it, but they still have a non-paying tenant, if you will, an occupant of the house that is not being evicted because the sheriff does not seem to want to take action. I mean, how do you handle something like that?
So there are a lot of people out there that are homesteaders, and they just sit themselves in the home, and they don't want to go ahead and leave the property. So obviously, you have to go ahead and provide a different alternative resource. Now, do you serve them with a warrant? You're saying you have to vacate the property, you have so many days, and do you have squatters' rights? That's a good question, Doug. It can be difficult, and yes, you're right, because they purchased the house, but you should look at some as a person before you actually close. You should make sure that the house is vacated and nobody lived in the house.
John, like if you were putting together like your dream team, like you're a hard money lender, you're going to give money to somebody. I would like you to say like, okay, hey, Robin, if you're going to start your home flipping business, here's your dream team of advisors that I'd like to know you have lined up. Who would those people be that would be advising me, the potential buyer of these properties, to give you assurance that you're not going to make a bad loan to me?
Well, where I work in this industry, I work with a direct lender. So therefore, when you submit your loan, I review it. I take a look at your credit score, your income, your collateral, your experience, and that's an acronym that's called ICE. And then you have your rehab costs, and you have your profit margin. And then you have specific, like if you're looking at a multifamily home, usually lenders will not provide a loan to a multifamily home unless it has a 75% occupancy. Now, if you're doing a single family residence, we want to make sure that you have the experience of doing single family residence at least 2 to 3 properties a year. So
Oh, wow.
yeah, that's going to be a major factor, because if you don't have the experience on handling a single family resident fix and flip,
Yeah.
they're not going to lend you the money.
So you're talking about 3 transactions a year where you're actually buying, renovating, and flipping, as opposed to buying to rent, buying to
Well,
operate. Is that correct?
there is a terminology that's called buy and hold,
Right.
which basically real estate investors will do to build a portfolio of properties, to build up their rental.
Right.
But all in all, Doug, they still need to have, and they still need to show.
They got to have a business plan.
Yeah, the HUD settlement sheet.
Right. Right.
Yeah.
They need to show that.
Right.
And they need to forward that to us with all the properties that they have closed.
Okay.
Wow.
Yeah. I mean, which is basically a history.
Yeah.
I mean, they have to be able to show a history of running a valid business that is successful.
But
Right.
how do
And
you start it?
business
I mean,
improvement.
how does anybody start this? Like I want to start the business. I can't get money through Bank of America, so I come to you, John. So I'm saying to you, what makes you decide to invest in me? Is it my dream team of advisors, or my credit score, or how do I get the money?
Robin, your credit score is going to be a big factor.
Yeah.
The down payment is going to be a big factor.
Like what percent you want to see?
Well, let's say the 2 original origination points. Depending, it's 2 to 3 origination points, and they're negotiable and they're flexible. But if you're doing for every 100,000, you're going to go 20,000 down.
Okay. All right.
And that can be negotiable down to 10%, 15%.
Yeah.
So you have to know the fact that, one, you've got to be able to pay the points and the fees.
Right.
Yeah.
If your credit score is 650, they'll probably do it, but you're going to have the higher interest rates.
Yeah.
You're going to get like an 8.5%, 9%, probably 10% interest rate.
Okay.
Now, if your credit score is 680 and above, which basically we do in-house lending, then it's going to be easier. But once you outsource it, then that broker fee comes upon. You get the broker fee for the outsourcing and the in-house fee as well. So you can get up to 4 points.
Wow. So
Okay.
this is great, because you're really answering for us the main factors for anybody who's considering a loan request. What do they need to be thinking about, right, to get one of these hard money loans?
Yeah.
It's very helpful. And are there other factors that determine the fix flip industry that you want to share with people?
Well, I know one factor that does actually determine the industry, and that's the interest in the housing market.
You mean the current interest rate, right?
Yeah, because
Sure.
I mean, the lenders are going to go by the current interest rate.
Right.
They're going to say, okay, the interest rate's 7%. So therefore, if you have a great credit score, they're going to give you an interest rate between 7 and 9%.
Okay.
Right. Right. Yeah. Well, and of course, all that's driven by the Federal Reserve and the Fed funds rate, the discount rate, and the 10-year Treasury, which really drives mortgage rates. But the reality is, if people are getting 6-7% on a 30-year mortgage, a hard money lender is likely going to be charging a bit more than that. One, because they're taking more risk, because it may not be a stellar borrower. Two, you got somebody who's in this for a business, fix and flip, as opposed to somebody who's making it their personal residence. So there's additional risk there, and that's one of the reasons why I presume they're requiring more money down, 20% or more, which generally would get people out of private mortgage insurance if they were dealing with a bank on a mortgage.
Right.
Right.
Yeah. So basically the industry is based on risk and rewards.
Right.
The greater the risk, the more the interest rates. The less the risk, the less the interest rates.
And you guys are holding for a shorter period of time, because like a mortgage, 15 years or 30 years. How long is your average hold period on these loans, John?
Robin, that's a good question, because there's several loans that the borrower can go for. A fix and flip, it's usually 6 months, and sometimes we give them 9 to 12 months. And the reason why, usually it's like a 3-month for rehab, and then after rehab, it could be 3 months for the to sell the property.
Yeah, to sell.
Right.
Yeah.
Right. So it's usually a 6 months fix and flip with no prepayment penalty.
Oh.
And with the rehab, let's say it's $100,000 and the rehab is $50,000, they can get a draw on that $50,000 as the work is completed. Now, some borrowers will request like it's a bridge loan or a DSCR loan, and those loans can go 15 to 30 years.
Right.
Wow.
Yeah.
That's principally the buy and hold.
Right. Yes.
Buyers. So, we mentioned up front that, for a lot of these borrowers are really trying to capitalize on a short turnaround time. How long does it take when applying for a fix and flip in order to get the loan approved, assuming everybody's got their ducks lined up?
Well, Doug, that's a really good question, because of the fact it can vary. And why I say that is, one, it is really important for the borrower to be honest up front.
Yeah.
Because if they're not honest, it's going to delay the loan. I'll give you an example. I had a gentleman that was wanting a $25 million loan for vertical and horizontal development in Hawaii. And his partner had a background history of some felony offense, and they would not loan it.
Oh, geez.
And all the paperwork was lined up.
Yeah.
But if everything is good, they can give a loan within 14 to 30 days.
Wow. So that's pretty good turnaround time.
Yeah.
That's awesome.
Depending if all the docs are in the house.
That's fantastic. Well, this has been extremely interesting in an area of the market that I've never really explored. It sounds like you're ready to jump in, Robin.
I was just saying, I love those HGTV shows on the house flipping. I mean, so many of us with us. And we see the guys, the money man. They always say, here's the money man writing the check while the other guys are, you know. So this was a really fun show, John. We learned a lot, and I will never watch HGTV the same way again. So thank you.
Fantastic. Yeah, thanks, John, for sharing your insights on the hard money lending. It was a pleasure having you on the show. I also want to thank the people who work behind the scenes to make this show possible. In particular, Robin being my lovely co-host. And be sure to tune into our next episode with Jeff Watkinson of Watkinson Capital Advisors. Most importantly, we want to thank you, our viewers, for tuning into our program. Until next time, make it a great day.